Hey everyone, so today we're with Bob Gauvreau from Gauvreau and Associates. Bob, tell us a bit about yourself.
Well, it's I feel a very interesting story, but maybe others don't feel that way. Started my firm in 2008. I actually articled with one of the large national firms, got
Nice.
my experience there. Decided I was going to leave that firm because I felt like I wasn't aligned with the values, and I was starting to do work that wasn't interesting to me. And so in 2008, I left. I started my own firm focusing specifically on business owners, which is my passion. We currently work with 4,000 business owners across Canada and the United States. And so started that firm myself, one employee. Ultimately, we were looking to surround those business owners with all of the professional services that they would need. So bookkeeping, accounting, tax services. We even have legal services in-house, business valuations, business coaching, ultimately anything a business owner would need to be successful. So I'll give you the short version. Started in 2008 with just me, like I said. We're now just shy of 200 people. We have two offices, one in Peterborough and one in Winnipeg. And we have two satellite offices, one in Ottawa and one in Toronto. We are one of the fastest growing companies in Canada, according to the
Wow.
Globe and Mail. And we are one of the best places to work in Canada, just ranked as 126th, I believe, last week. So it's been an interesting journey building a business, but something that we're certainly very proud of.
That's
That's
awesome.
amazing.
That's a lot. That's amazing progress. Um, I think something we want to talk about is capital gains and how that applies to most people. So, like, let's say I bought, a house. It's my second one. I'm renting it out. I want to go sell it now. What would capital gains kind of look like in that scenario? Yeah, for someone.
So it's interesting. Capital gains. So there's a couple components to it, right? So first and foremost, I just want to clarify your principal residence is still not taxable in Canada. However, it has been a conversation that has sort of come up in a preliminary budget discussion that it could be something I know, which would be devastating for so many families who've built their equity in their principal residence, right? Their largest asset. But thinking of the people who've invested in a second property, and I'll maybe distinguish this in two separate ways. One is like a secondary recreational property, like a cottage,
Mhm.
and then the other one would be like a rental property, for example. So, recreational property, you don't really get to deduct anything along the way because it's considered personal use. So, really, you've got the cost of what you purchased it for. And then when you eventually sell it, any of the additions, the capital investments that you made over a period of time, it counts towards the cost base. So, if you buy it for $100,000, put 50,000 in, your cost base is now 150. If you sell it for 200,000, we have to pay capital gains on that $50,000 worth of growth
Oh, really? On your cottage?
on your cottage. So not that we're selling too many cottages for
Right.
200,000 right now, but the numbers were easy. So what it would look like is that 200,000 minus the 150, we're paying about 25% tax on that. That's our capital gains sort of tax rate.
Hmm.
It's half of everything else. There was a proposal to go in that it was going to be two-thirds, which was going to increase it to about 33%. But in this case right now, we're lucky that it sort of stuck at 25. So that's the recreational side. So if you think of the rental property side, which is probably where we get more actively involved, you've got a property that's generating some type of passive investment income. Hopefully, it's generating positive cash flow because that doesn't happen as often as we would like to see as well. So, and cash flow meaning you've got your rental income minus your mortgage payments and then all of the costs of property taxes and everything like that.
Hmm.
So when you go to sell your rental property, there's a few other considerations that may come into play. One is whether you've depreciated the property or not.
Hmm.
If you've depreciated the property, there's actually another tax that you would pay. It's called recapture. So again, let's use my $100,000 example. We buy a property for $100,000, we depreciate it down to $50,000.
Hmm.
So that 50,000 we've essentially claimed as an expense along the way that says, this is being used up. It's not going to be as valuable in the future. And that's just the way the tax system works. So we're down to, a $50,000 out of a $100,000 investment. If if you sell it for 300,000, the first tax we have to pay is the recapture of that depreciation. And this is where a lot of rental property owners get caught with a big tax bill because that depreciation didn't actually happen. The property appreciated
Right.
in value. So you got to repay that, right? So if it's $50,000 in depreciation, you have to claim all of that 50,000 back when you sell the property.
Oh.
So then on top of that, we've got the same capital gains calculation as you had on the recreational property. Whatever your cost base was, plus any additions, the difference between the sale price and that cost, 25%. So you could technically be paying, upwards of 70% tax in selling a rental property if you're not careful. So depreciation is a big one that people have to pay attention to.
So how does this explain that to me again with the recapture? So like, let's say you depreciated 50,000.
Yeah.
And then when you go to sell it, you're claiming it as recapture, and that goes against the like adjusted cost basis, or does it?
It's a totally separate calculation.
Oh, okay.
So we've still got the capital gain piece, but then we've got, okay, you over depreciated this asset.
Oh, if you overdo it.
Yeah.
Okay.
Which ultimately would be if you sell it for anything more than what you bought it for.
Okay.
If you sell it for less, so if we sold it for 50,000, then it doesn't apply
Right.
because we haven't over depreciated it.
Right.
So we may see, if someone's been buying and selling within the last 24 months, you could see somebody that's not getting that recapture, maybe not even capital gains because the market is shifted a little bit. But, a lot of the people who've had properties for 10 plus years, there's substantial capital gains. And if they have depreciated it, they're going to have to repay the deduction that they took.
So I guess I just want to say, like, so I guess you would need to be working with an accountant that understands, like, if you are going to depreciate this asset, be aware that you could have a tax bill on sale that is
Yeah.
higher than you might expect because of the depreciation factor.
100%.
And maybe trying to understand, like, forecasting, right? Like forecasting depreciation and forecasting
Yep.
appreciation of the asset.
And I think it's a discussion, like a strategic discussion as you're going through that and you're doing your regular filings. Because a lot of times if we've got somebody who owns one rental unit, we won't depreciate their property just to avoid that sort of conversation happening in the future or that situation happening because people don't necessarily understand it.
Right.
So do you find that a lot of people when they're selling their cottage or investment properties after the fact, they realize this, they had no idea?
Yeah, well, we get a lot of people who have been filing their own tax returns, right?
Right.
Which is fine. File your own tax returns. We can't do them all. But they come to us when there's been some sort of transaction that's complicated.
Right.
So they come in and they go, oh, well, we didn't know. We've
So
just
they
been
have to put that.
depreciating it, which is
Very
fine.
nice.
And we do, but we can't eliminate, what's happened over that period
Yeah,
of time.
Still taking place.
It still happened, and we're going to have to deal with it in the best way possible. And we can likely find a better outcome, but it's sometimes not the best situation.
Most people would contact their accountant first, you think, when they're looking at selling their cottage? Or not really? Not as much as
Yeah, not as much as you would think, right? Like you might contact the accountant and say, hey, I'm doing this. What's the implication of it? Because once you've been burnt once,
right.
then you feel like, oh, we have to have those conversations in advance. But a lot of times when people are selling their first rental property, that's not the case. They haven't really been burnt. They've been an employee.
Right.
They've had tax withheld. Everything's been pretty simple. And then all of a sudden they get proceeds on a property that maybe they refinanced over the years, kept putting equity into it or pulling it out to live life. And now they've got this large mortgage and they've got a huge capital gain and all the recapture. So we've seen a lot of times where that's caused a lot of financial strain, and not only for individuals, but in marriages. And,
Oh yeah.
it's challenging. And in an economy right now where we're short on houses, it's forcing a lot of people to not sell because they don't want to trigger these tax outcomes. So it's, when you guys are looking at the market supply and you're going, oh, the market supply is low, part of the challenge is that nobody wants to sell to deal with these tax
for
implications.
sure. Yeah.
Exactly.
And how does it work, I guess, with estates as well? So
Yeah. So, it becomes a little bit more of a challenging conversation when we're dealing with people who've passed away or even planning for people who are going to pass away. However, these are conversations we should be having.
Oh, definitely.
Right. And we should be having it about how are we going to leave things for our kids? What does that look like? I'll give you a good example and I'll answer your question about the estate at the same time. family cottages are a big one that hit estates, and they're challenging because a lot of times they've been in the family for 30 years. And what happens is when you own a property and you're the last surviving spouse. So let's say my wife has passed away. I own this property. I'm the last surviving spouse. As soon as I die, it's deemed disposition at fair market value. So whether I keep the property or my kids keep the property or not, tax needs to be paid on that gain. And if you think of how many family cottages have been in the family since the 60s, 70s, they paid $10,000 for it, and now all of a sudden it's worth $3 million. You've got the next generation is going to have to come up with that cash to pay the tax bill. So deemed disposition, fair market value when a person passes away, there's no way to avoid that at that time in transferring that to the next generation. So a lot of times people either have to refinance and borrow money against the property to pay the tax bill, or they sell it.
Or hope they have a good life insurance policy, maybe.
Or a good life
Joint
insurance
lapse
policy,
die or
potentially, right? Sometimes you get it where it gets really complicated. You've got multiple siblings and you've got a property and they don't talk to each other. So who's getting the property? These are things that need to be thought out and not just left to the kids to deal with, right?
Might seem like a silly question, but just from my lack of knowledge on this, like say like I own a cottage, I'm 80 and I have 2 sons or something, and would that make sense then for them to pass it off to the sons prior to death, so that way it doesn't trigger a disposition, or does it still, there's still a transfer of ownership, so maybe there's still
That's a
a
good
tax
question.
Yeah,
implication there?
no, great question. And so unfortunately, even at that time, there is a disposition, which is
Can it be below market value in that
it
thing,
can't
or
be.
not?
Yeah, the Canada Revenue Agency, they will, and the tax
Well, you know how
still.
like on the Geo warehouse, you always see like transfer $2 or like something like that.
Yeah.
So I see
Yeah.
that sometimes, and I'm like,
Yeah. So it may be for transactional purposes that they throw that in there.
yeah,
But it wouldn't be for tax,
right, different with
right?
yeah.
So yes, and these are questions, that I get all the time where it's like, well, my neighbor just transferred it for $2, so that I must be able to do the same things. Well, no, if you don't know the circumstances, it might be a different situation altogether.
Yeah.
But no, as soon as there's any sort of disposition of ownership, there would have to be some sort of proportionate claim. So what you do see though, which is a good planning opportunity, is when people are getting older that they do put their kids on for title, but maybe 1%. And what that does, it's not an income tax planning opportunity, but it's a probate planning opportunity. So if they don't do that, the property has probate attached to it, which is somewhere 2 to 4%.
Yeah.
Just the death tax.
So you can avoid the probate fee.
So you can avoid that. Same with any sort of bank accounts or anything like that. Putting your kids on your bank accounts avoids it going into and getting taxed as probate.
Makes sense.
Yeah.
Yeah, that's a big process.
So like if I was to go out and get a rental property, from the most simplistic standpoint, what would be, in terms of like next steps, like 1 or 2 things you would say is good to do, just in general, like maybe to look into something or have a certain conversation on something specific, like capital gains.
Yeah.
If I want to get a rental property, like a single family home to rent out, or a duplex or something.
Yeah. I would say first and foremost, and sorry guys, I know we're in a real estate podcast, but real estate and rental properties aren't for everybody.
Yeah.
And I think you need to know what that looks like. And like those rental properties are going to sell. So just know that because other people do real estate rentals, like it doesn't mean that that's meant for you. I'm probably, I have the opportunity to be part of a few fairly decent sized residential, or not residential, but commercial. There's some residential in there, but some real estate investments, which is great. I am not a good landlord though, right? So I have partners who are great landlords. I am not one. I do not want to get the call that the power is out, that the toilet is plugged, any of that. Like dealing with the tenants that won't leave, like that's not for me.
Your thing, yeah.
So know that that's, your thing or not your thing. But for those that it makes sense for, which is a lot of people, right? Real estate is maybe the best investment that you can possibly make. Just know that it fits you. The first thing I would look at is cash flow of these properties. I have another good example. I had a client who sold a business back in 2009 or 10 for a small amount of money. It wasn't a big business. She took all of that money. She put it in on a down payment on a residential rental. There was 5 or 6 units. It was a multi-million-dollar property, and it was going to make, I think, $150,000 a year net income. But the cash flow was about 40,000 negative on that property. So it drained her over 2 years. So all the equity that she put in, it drained. She had to sell and get out of this property because it couldn't cash flow. So I think you need to preemptively look at financing. Make sure that you're able to get the financing to substantiate the real estate investment, and make sure that it's not going to drain your other resources.
Yeah.
Find the right property, right?
Mhm.
And that's why they
like
work
buying
with
a
experts
business,
with you
right?
guys, right? Find the right property that's fitting for those people, because you can get into real estate and it can cause you to have some major financial hiccups. You may make money to get out of it, but you might have to get in and out really quick and lose some equity along the way. So that would be the first one. The second one would be, once you do get into it, just be aware of what the tax implications would be associated with it, because you get to the end of the first year, there could be, if you're making money on your income, right? Your cash flow might be break even, but you might be paying tax on that property as well, because principal is not deductible.
Yeah.
So if they're paying a large principal amount, that's not an expense. They could have no money left for this rental property and have a big tax bill. So just understand how that works as well. But truthfully, if you understand real estate and it makes sense for you as an investor, it's likely the best opportunity you have to really build your net worth.
Mm-hmm. And speak with an accountant about the tax implications, not the realtor. There's different people in the transaction that they need to go to, the experts for what it is that they're inquiring about.
Well, we even talked about AI, right? We were sort of joking how much we all use ChatGPT now.
Yeah.
And it's great. However, it's really collecting information from all available sources. So we go back to the neighbor who transferred for $1. It's like, okay, well, yes, you can transfer for $1, but what are the implications of it, right? CRA would suggest if you transfer it for $1, you're going to pay tax on fair market value anyway. And the buyer gets the new cost base of $1, not the fair market value. So it's a huge double taxation is the actual case with that. But because somebody transfers it for $1, like, oh, well, maybe I could transfer it for $1 too. You can, until you get caught. And it's actually against the law. So I should probably say that as well, to not claim it at fair market value. So, having that knowledge and avoiding just everybody's advice for you. Talk to the people, talk to the real estate agents, talk to the accountants who know the answers to support you in this journey.
Mm-hmm. Is there anything, like when you look at, say, like home insurance, maintenance, like snow removal, garbage removal, utilities, heat, hydro, water, sewer, are all those typically deductions for tax on, say, multifamily?
Yeah, so I have a general rule of thumb with whether it's business or real estate, anything that you're incurring a cost related to that's helping generate income, right? So any of those expenses that you just talked about, interest, property tax, utilities, all deductible, because you're incurring those with the response of generating rental income.
Yeah.
Even if you don't have rental income, right? If you had a vacancy in there and you're still incurring these expenses, the intent is that you're going to rent it, so it is still deductible. Now, there is a little subsection of this. If you've got a cottage and you're saying that you're trying to rent it and you're not actually renting it, you're using it, then we have a personal use issue where it doesn't become deductible. But, what I always suggest is create the story of what it is that you need to tell in order to explain it to some tax authority that you've tried. Have an advertisement out. Maybe people don't rent it as often as you'd like them to generate income, but have, some backup and some story to be able to substantiate that. Because if you come to me and say, oh, the government's after me because I claimed all these deductions, can you help me? Like, well, where's your story? Where's your ad? Did you try and rent it? Prove that to me. Like, if you can't prove it to me, we can't prove it to them.
For
Yeah.
sure.
So
good
let's
story.
back up our story.
Exactly.
Yeah.
Makes sense. Any more questions, Jess? Are you good?
No, that was great. And
I think that was awesome.
fun.
Yeah.
Yeah.
Thank
Great.
you.
Thank you for your time, Bob.
Yeah, my pleasure.
Appreciate it.